cost for decision making. Now, this is not A versus B. This is just different costs that managers need to be aware of when it comes to decision making. So let's refer back to what decision making is. It's important to realize that every decision involves a choice between at least two decisions. Most of the stuff we do in our lives is dealing with at least one of two alternatives. Now, the goal of decision making is to identify those costs that are either relevant or irrelevant to the decision. So let's look at some of these costs that are associated with decision making. The first one is differential cost. The differential cost is just simply the difference between the cost of two alternatives. So if you're looking at two cars that you're potentially purchasing or you're thinking about purchasing, if you were to take the cost of car A and the cost of car B and subtract the two, that's the differential cost. It's a very basic cost difference that you can use in decision making, but it doesn't give you the whole picture. It's just very quick to get. The second one is opportunity cost. Opportunity cost is the potential benefits that is given up when one alternative is selected over the other. So it's not necessarily the difference, the main difference, the direct difference between the two alternatives, but it's to say, if I were to pick B over A, what am I giving up in A? That is the opportunity cost. This is one of those areas that a lot of businesses need to focus on, but sometimes they don't because it's not upfront. What could you be doing with this if you chose this over that? The last one is sunk cost. Sunk cost is a cost that's already been incurred and that cannot be changed now or in the future. These are things that already have happened. You've already paid for it. The cost has already been paid. But yet we tend to use these for decision making, and we don't want to. That's actually called the sunk cost fallacy. That is using a sunk cost to make a decision, a past cost that can't change the future, but using a past cost in order to make a decision for the future. And that's not a good thing for a business executive to do. So this is your 3 costs for decision making.